Hey traders, in this video I'm going to cover the market internals, the pivot points, and kind of what I'm talking about in the chat room every day when I call out shorts and things of that sort. I'm going to start out here with what usually the first thing I post in the morning, or one of the few first things, are pivot points. And pivot points are just price action from yesterday's movement, and it's usually the high low and the closing price divided by 3, and that gives a range of levels for the next day. And traders typically use this to look at it as support and resistance levels to either sell into or to buy off of. So I post usually in the morning. I post from the SPY, from the ESs, and the Nasdaq futures and things of that sort. So those are just price levels where you can typically see prices run into and then fade off of, or if we see selling in the marketplace where buyers can potentially step in for a short-term trade. And that's how day traders, it's a day trading tool, use those indicators. It uses the pivot points. And I post that because on the futures, what we typically see is levels where if it's bullish prices, and when I talk about resistance 1 or resistance 2, where prices will run up to, we'll see a move higher, and then you'll typically see traders fade that move, and that's what I talk about, fading. And it's a fade where there's some selling there, it pulls back, and if the market is strong, which I'll go into the internals in a second, you'll see a pullback, which is a flag intraday, and then you'll break above that resistance 1 and then run up to R2 and so forth. So again, there's levels and just a little bit more kind of insight of where to take profits and where to take losses by having those pivots. And that's how I use those when I'm trading the futures. Now, what you're looking at here is part of my screen, and this is what I typically look at on one of my screens. And I'm going to go through each one of these and explain to you what each one is. So at the top left-hand side here is this U-vol versus down-vol, and this is up volume up volume minus down volume. And this is what I refer to as the breadth. This is the kind of the big boat throughout the day. This is a 5-minute chart, and on this, taking a look at what this day was, you can see that it really didn't move that much. 0 obviously is going to be the mean, and then anything below it is weakness, and then anything above it is going to be strength. Well, if we don't really see a trend in the breadth, meaning that over time, like the day before, this is the previous days, that we saw this trend continue here and the market was continuously weak, and this is what you look for. So when you see something like this in the breadth, that even though that you might get moves higher, you still want to short into those moves because the overall trend is lower. And this is just taking up volume versus down volume. So on a day such as this, you're going to see more stocks, more volume going into down stocks than are going into the up stocks. And this is taking on the the NYSE exchange, the NYSE. How that fluctuates with the ES futures is that the futures are actually based off of what's going on in the stocks here. And most of the stocks that are traded in the S&P 500 futures are on the NYSE exchange. So when you start seeing moves in the stocks on the NYSE, typically the futures are going to follow. And most people think that futures follow the stocks. It's actually the opposite way around. You'll start seeing stocks move before the futures. There's a little bit of an inclination where the stocks start moving and then the futures start to catch up a little bit. Next to it here is advance versus decline, and this is stocks that are advancing on the NYSE versus stocks that are declining. And this one is kind of second. So first one is this one, the U-vol versus down-vol. Second one is advance versus declines, and this is number 2 on things to follow. And you can see here that advance versus decliners, that we had a nice trend lower here, going with the biased, and that weakness that we saw continued here. On this day as well, we saw that it was pretty choppy, and we saw choppy trade. And what that means on choppy trading is that you want to play those levels of pivots where you get those range bound moves. So you buy off of a value, or high or low, or the pivot, and so forth. So you saw here that's trending. So again, this is a perfect example of a trending day here, just a range day, and then a trending day lower. And obviously it would be, if it was at a trend day higher, you would see it flipped up here and turning the other way around. You'd see it move up higher. And then what is like the short-term indicator is the issues going, the tick, which is issues going up versus the down ratio. And this means that on a short-term basis, it's how many stocks are trading on a higher tick than on a low tick. So meaning that if stocks are hitting up on a high tick, that you're seeing it continuously, you're seeing buyers step in on a higher and higher tick, and it would be the opposite for what's going on the downside. And you can see here that we are trending here, and my lines here indicate overbought and oversold tick readings, and these are very short term. So when you get a very big spike here, you can typically see that it starts to fade here. And I can line it up just how this looks here. So right about 1405 here, you see this, and about 1405 you got that high reading here, and then you started to see that fading and started to see that selling come into place here. And then kind of the short-term pop here was about 1245, and you could start seeing here that we started to turn here about that 1245 level. And we got that pop, and we got buying coming in here, and you could start seeing how this lines up all together, where this, if it's trading sideways, that the market's going to trade sideways here, and you got the advance versus decliners trading sideways, and then short term you get these movements, and this is where you want to you sell into those resistance, where you get an overbought territory. You look to sell it, look to fade it, and again 1130 and just about that 1135, this area right here, it started to fade out and came back, and again overbought here at 950. And just right about 9:50, or about 10 o'clock, 9:55, it started to fade out as well. So this is how you use this, and this is how I look at it every day. And this is on the NYSE exchange, which controls the E-mini futures, which are traded on the Chicago Mercantile Exchange in Chicago. Now right below it here, I have the same thing, but it's only this one is for the Nasdaq, and the Nasdaq futures are going to be traded on the CME as well, but the Nasdaq exchange obviously are going to have the stocks that are part of the Nasdaq, and you can see it here as well, where we kind of saw that on this day again that we had that trend lower, same thing in the advanced decline lines, and then today we had sideways action and sideways action as well. And I'll move this back here. You can see here on the Nasdaq futures right here that we had that sideways movement. We had a move higher here, but really it just traded in a range from 2319 to 2340, and we see here on the tick as well that we had that movements here. So 1050, 11 o'clock, and you got that little bit overbought here at 1145, which was about 12 o'clock here, and then you got that really good reading here at 1355. And that's where it topped out and started to fade here. So this is how you would use the internals that I talk about, and these are the internals. These three right here, and and that's the future. So when I talk about internals, I talk about the breadth, which is number one, the advance versus decline line, which is number two, and then short-term trading is the tick. And you might see movements higher here in the tick, which indicate maybe a turn in the marketplace. But if the movement is lower here, you have a nice trend starting here, and then you start seeing this come into play as well. When you start seeing these overbought readings here, that's where you could start to look to fade, and then you use those pivot points that I talk about to fade. And when I mean fade, you sell short. So you have a low risk to reward trade. You have the market in your favor. You have stocks going lower. And then you have the futures coming into a low risk to reward. I'm sorry, you have the futures coming into a resistance area. So that's where you look to fade it. And that's how I use the market. And I talk about the value area high, low, and the point of control. And it's not listed on here because I don't have it showing after hours. But the value area is a profile. It's called a market profile. And the point of control is what most traders look at on the on the floor, and that is where 70% of yesterday's volume traded at that price point. So to them, that's where value is, and that's all that means. That means that's value there because that's where most of the volume traded at that price point. So then where you get the value area high and low is a standard deviation that they take. So if the futures are trading in that value area high or low, that's just kind of a sideways trading market. And as of today, we did trade in that value area high low point. And then when you start getting out of that value area high, that's where you want to look at the internals and to see if we have a trending day. If we have a trending day, that's when you use those pivot points, resistance 1, resistance 2, or support 1, support 2, and that's how you all kind of tie that in together. So I hope the video helps a little bit more understanding on how I trade the futures and what I'm looking at and how it can help you really on your day trades, because on different trades, when I'm talking about different call activity and some day trades, is that if you have the market in your favor, sometimes you get shaken out. So you might be looking to play something long, but if I'm saying the market is bearish, then you're going against the whole market, and that's why most people lose money, is because they're going against the major trend. So you really want to keep intact of what I'm talking about in the chat room of if the market is if the market's bearish and you're trying to look to go long, you're on the wrong side. Now if you're looking to play a breakout trade and the market's trading sideways, that's fine, because there's certain stocks that are going to trade strong during that day. But if you're looking to play something long and market's going lower, you're on the opposite side. And same thing, if the market's higher and you're looking to short something, you're on the wrong side. You want to look to the sectors, and I go over the sectors as well that are strong, and then start at that sector, look for the strongest stock, and that's the one you want to look for pullbacks in when the market pulls back, and you look to play that. Same thing here. You might not want to play the futures, but I suggest playing the futures